Money makes the world go round, and for many years the US dollar has been the currency at the center of the global finance. Now, as the global economy continues to evolve and shift, there's a growing debate about the future of the US dollar as the world's primary reserve currency. While some experts argue that the dollar's dominance is being threatened by other currencies such as the euro, the Chinese yuan, and even cryptocurrencies like Bitcoin, others maintain that the dollar's position as king of currencies remains unchallenged. Now, in this episode of The Third Empire, we try to explore the various factors that could impact the dollar's status and to consider whether the reign is indeed in jeopardy. So, what's in store for the greenback dollar? Is there a new king in town? Let's find out. Now, while we do that, the global economy continues to face unprecedented challenges. And amidst these challenges, the Indian economy has emerged as a beacon of resilience and of strength. Now, while robust macroeconomic fundamentals and a diverse range of industries, India has weathered the storm of not just the pandemic, but also the geopolitical tensions between Russia and Ukraine and their after effects as well, and positioned itself for growth in FY24. Now, as we reflect on the past year and look ahead into the future, it's clear that the Indian economy is a force to reckon with on the global stage. So, what all are the factors that have contributed to India's success? Let's dive in and take a closer look at some of the macroeconomic indicators which will help us understand the health of the Indian economy slightly better. You watching Informed Investor, The Third Empire, an initiative by ResearchAndRanking. Let's begin. Now, the US dollar has held a position of dominance in the realm of international trade for decades. Its ubiquity in the world of finances has made it the go-to currency for a vast range of transactions, from global commerce to the exchange of goods and services. But despite its long-standing reign, recent trends suggest that the world may be moving away from the almighty dollar. Now, the dominant position of the US dollar has an impact on almost everyone, as it is the most commonly held reserve currency globally and is involved in approximately 90% of all the foreign exchange transactions. Now, a quick internet search will reveal why de-dollarization has become a common topic of market observers. De-dollarization is somewhat an old topic starting off around 2010 amidst the banking crisis in the US. Then in 2014, China and Russia teamed up to work towards moving away from the dollar after Russia first invaded Ukraine. Now, there are reasons why several countries are looking for ways to avoid the dominance of the US currency. The US has used the currency as a weapon by employing economic sanctions, freezing assets, and sometimes outright confiscation as financial means to influence countries that do not follow Washington DC's wishes. Now, the most recent example of such practices can be seen in the measures imposed against Russia in connection with the conflict in Ukraine. The countries are increasingly seeking to reduce the reliance on US dollar. Let's see some examples here. Now, among the BRICS group, Brazil, Russia, India, China, and South Africa, China and Russia are leading the de-dollarization efforts due to their geopolitical rivalry with the US. Now, the use of local currency is on the rise to replace the dollar in Russia-China bilateral trade, with the Russian ruble and the Chinese yuan accounting for 2/3 of the trade payments between the two nations. The ruble-yuan trade volume surged after Russia's invasion of Ukraine, which led to unprecedented Western sanctions against Russia. With China's increased purchase of Russian exports and China's exports to Russia soaring, the ruble-yuan trade increased 80-fold from February to October 2022 and as has been reported by Reuters as well. Brazil, the largest country in South America and an important member of the economic bloc BRICS, is partnering with Argentina to launch a joint currency named SIR that may eventually become South America's euro and be adopted by all the continent's countries. The common currency is expected to strengthen regional trade and lessen the dependency on the US dollar. In Jan 2023, South African Foreign Minister Naledi Pandor said BRICS is exploring ideas to create a fairer payment system that reduces dependence on the dollars. Last year, the BRICS countries kickstarted talks to develop a new reserve currency that would be based on a basket of currencies of its 5 members. Now, this is being done to reduce its reliance on the greenback and present an alternative to the US dollar. Southeast Asia too has taken an important step in de-dollarization. Southeast Asia's largest countries, Indonesia, Thailand, Malaysia, Singapore, and the Philippines, have developed a digital payment system to trade between these countries in their local currencies, bypassing the need of relying on the US dollar as an intermediary. Meanwhile, India is in talks with the United Arab Emirates to trade non-oil commodities in the Indian rupee. Now, the UAE's trade deal with India aims to increase bilateral non-oil trade to 100 billion US dollars over the next 5-year period. Furthermore, according to an Indian Ministry of Commerce official, Russia, Sri Lanka, Mauritius, and Bangladesh are some of the other countries that are keen on rupee trade with India. India's rupee trade settlement mechanism, which was set up by the Reserve Bank of India in July 2022, is attracting interest from more and more countries, as the trade settlement mechanism is a means of using rupees instead of dollars and other big currencies for international transactions. While this will help reduce India's dependency on US dollars, the move to encourage international trade settlement in rupees is primarily being done to promote the rupee as a global currency and to settle trades in rupees to save dollar outflows, given that India runs a trade deficit where imports are greater than its exports. Now, after being pegged to the dollar for nearly 5 decades, Saudi Arabia's finance minister Mohammed Al Jadaan announced in Davos in January that the world's biggest oil producer will consider trading in currencies other than the US dollar. Now, this is being interpreted as a sign that the oil-rich nations may be ready to diversify away from the greenback dollar. Now, we're seeing countries increasingly trying to lessen the dependence on the US dollar. The dollar's share of global foreign exchange reserves fell below 59% in the final quarter of the last year, ending a 2-decade decline according to the IMF's currency composition of official foreign exchange reserves data. Now, this decline in the dollar share is not a shift towards the euro, the British pound sterling, and the Japanese yuan, but has been matched by a rise in the share of what we refer to as the non-traditional reserve currencies, which is defined as the currencies other than the US dollar, the euro, the Japanese yen, and the British pound sterling. Now, it is difficult to predict the future of the global financial system with certainty at this point. So, the dollar has been the dominant currency in international trade and finance for many decades, and it is likely to remain so as an important currency in the foreseeable future as well. However, the increasing efforts of countries like China, Russia, and others to de-dollarize and promote the use of alternate currencies could lead to a gradual decline in dollar's dominance. Moreover, the rise of digital assets and the potential development of new payment systems could also challenge the dollar's role as the primary reserve currency. However, the US has significant economic and political influence globally, and the dollar's status as the primary reserve currency is deeply ingrained in the global financial system. Therefore, any changes in the dollar's dominance are likely to happen gradually over time rather than suddenly. Now, there was no dearth of headwinds throughout the last year which impacted India's path to economic recovery. The year began with the threat of the Omicron variant of COVID. Fortunately, the threat subsided fairly quickly without impacting the economy in any significant way. Now, the only problem was that this headwind was replaced by Russia's invasion of Ukraine in mid-February, leading to further disruptions in the global supply chain. Now, the next development to impact the global economy was the decision of several major central banks, especially the US Federal Reserve, to reverse their loose monetary policy stance. Now, the ripple effect of the policy tightening measures were felt worldwide. Now, the RBI wasn't too far behind in tightening its stance either, with the first interest rate hike being announced in May. While that has continued until recently, the Indian economy has continued to show resilience in the face of multiple adversities, some of which I've just outlined. Having said that, what is the current state of the Indian economy and what should we be expecting going forward? Let's talk about that by looking at some of the data points. The first being inflation. As we're aware, inflation has been a major pain for the global economies and the stock markets of late. The latest March inflation data, which was released this week, shows the retail inflation dropped to 5.66% year-on-year. The current level of inflation is within the target range of the Reserve Bank of India, which targets inflation to range between 2% and 6%. Now, the rate of inflation is currently decreasing, and this trend may continue as a result of the delayed effects of the monetary tightening and the high base effect. However, there's a possibility that an increase in the global crude oil prices caused by the reduction in production from significant oil-producing countries or the OPEC nations could potentially pose a risk. Second, the credit growth. Now, the loan growth is a good lead indicator for economic performance as it is an integral part in supporting an economy's growth. Now, the credit offtake rose by 15% year-on-year for the fortnight ending March 24, 2023. Strong credit growth in FY23 was the result of a lower base from the last year. Personal loan, housing loans, auto loans, etc. Higher demand for NBFCs also played a key role in boosting the credit demand. We see that the credit growth has remained protected from global uncertainties like supply chain issues and global geopolitical tensions. Additionally, it has remained robust even amidst the significant rise in the interest rates. However, a slowdown in global growth due to rising interest rates and the rate hikes in India could impact the credit growth to a certain extent going forward. However, the deposit collection has failed to keep pace and is currently a little more than 10%. Lenders have been raising deposit rates to make them more and more attractive to customers. Hence, we see deposit growth inching higher going forward. The third being the Composite PMI. The S&P Global Composite India Output Index, which maps both manufacturing and services sector, came in at a strong 58.4. Any reading above 50 signifies that there's an expansion from the preceding month. At 58.4, the reading indicates that the growth is extremely strong. PMI is a survey-based measure of the top 500 companies, and it captures the bigger firms to see the improvement within the economy. The fourth is the GST Collections. We've been witnessing record GST collections, and this is a result of the tax reform measures. Inflation too had a very significant role to play. Now, this is one indicator that has been constantly robust, and that is the GST collections crossing 1 lakh crore mark every month since October 2020. March saw the second highest GST collections of 1.6 lakh crores. Now, the growth of GST collections in March was the fastest so far in 2023, marking the 12th month in a row that the inflows were over 1.4 lakh crores and the 4th month in FY23 over the 1.5 lakh crore mark. Now, GST collections is an important source of revenue to the government of India, and the government has taken several measures to improve the GST compliance and increase the collection. Fifth is the fiscal deficit. Now, the fiscal deficit refers to the gap between the government's total expenditure and its total revenue. Now, when the government spends more money than it takes in through the taxes and other sources of revenue, it runs into a fiscal deficit. Now, India's fiscal deficit for FY23 touched 14.54 trillion rupees in the 11 months through February. This is nearly 83% of the annual estimates. Now, the central government is on track to meet its fiscal deficit target of 6.4% of the GDP for the fiscal of FY23 on the back of strong growth in the revenue collections. As of right now, the centre's finances appear to be fairly in good shape. The sixth is the auto retail sales. Retail auto sales, which is a key economic indicator, showed positive trends for the entire FY23. FY23 was the first full year without any impact of COVID after a gap of 2 years. This year witnessed good double-digit growth for both the month and the fiscal year except for tractors. The EV segment is gaining a lot of popularity. However, the government's decision on the continuation of the FAME scheme is very critical and will decide the fate of the EV industry going forward. Now, in the midst of all of the global turmoil, India is in a relatively sweet spot. According to IMF, India's GDP growth is expected to decline from 6.8% in the last fiscal, which is FY23, to 5.9% in FY24, and then pick up to 6.3% in FY25. However, from the chart on your screen, India is still expected to be the fastest growing major economy, while the global growth rate is projected to decline from 3.4% in 2022 to 2.8% in 2023. Now, the PMI numbers are strong and inflationary pressures are slowing, with the CPI inflation to likely moderate, supported by the base effect going forward. Credit growth is strong. The corporate and bank balance sheet are in good shape, indicative of the relative resilience of the economy. While exports are slowing, likely moderation in the current account deficit and the ample forex reserves imply lesser external sector vulnerability for India. That being said, the India story continues to remain intact in the face of multiple adversities globally. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Take care and stay invested.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.